Lately, everyone's comparing the AI boom to the dot-com era.
Just what is this main artery of the information superhighway?
Every business, no matter how large, and no matter how small, will be on the internet in the year 2000.
The hype, the innovation, the feeling that something big is happening all over again.
But it's very hip to be on the internet right now.
Oh, and they're not wrong in some aspects, and they're not right in others. But to really understand where we might be headed, we've got to look back at where this all started. The moment the internet met Wall Street, the dot-com bubble. Consider the environment in addition to the hype.
So today, we're going down the rabbit hole once again, our own little trip to Wonderland, to explore what actually happened during the dot-com bubble.
Ooh, how it formed, why it burst, and what it can teach us right now as history starts to rhyme with the present.
Remember, history may haunt you. Markets are driven by supply and demand. And I've learned that it's just really human behavior at the end of the day. We're full of hope, hype, and a little bit of madness. Is this a Taylor Swift quote?
No, it's actually not, surprisingly.
Oh, okay. This is the Market Maker podcast, where two friends teach and learn investing education to all levels of self-directed investors by breaking down how markets work in a way that actually makes sense. But it's from her perspective.
That's right. You're in for fun financial literacy analogies that you probably haven't heard before because it's from the minds of two women.
Finance sisters, if you will.
I'm Jess and Skip. I act as a teacher, a formally licensed finance expert with over 15 years of self-directed investing experience. You may have seen me on popular finance media TV shows or on Instagram and TikTok and all the social media places.
And I'm Jessie Denui, the student and beginner investor who wants us all to learn how to do that thing rich people do where we make our money make money. And how the system really works. I'm not afraid to ask the questions we're all thinking, and I stop Jess when she gets jargony.
Together, we're on a mission to make you fin-fluent, not fin-fluenced.
Okay, Jess, what's on the agenda for today?
All right, so let's break this one into 3 parts. Think of it as our map through the madness of Wonderland. First, we'll set the scene with the economic environment of the 1990s. We have to think about the current environment when we think about everything else. So the perfect storm of optimism, cheap money, that sounds familiar, and new technology that made the bubble possible. Then we can walk through the timeline. So from the first sparks of the internet boom to the wild highs and painful crash that followed. And finally, digging into the psychology, the hype, that herd mentality, and the famous irrational exuberance, I'm doing air quotes here, that made even the smartest investors believe this time was different. Dangerous words.
Yeah, I don't remember hearing irrational exuberance. I'm happy to get into this. Basically, we're not just talking about a market bubble. We're unpacking how the internet money and human behavior collided to create one of the wildest chapters in financial history.
Exactly. And by the end, you'll understand why people keep comparing it to what's happening in markets right now. AI and the dot-com bubble. Revolutionary technology used everywhere. So let's go.
Everyone's talking about it's another bubble. AI is another bubble. So that's why we're talking about this. So the economic environment of the 1990s. So just before we dive into what actually popped the dot-com bubble, can we just rewind a little bit? What was going on in the economy during the 1990s that made this bubble even possible, even though we were both just born?
We were. Yes, absolutely. Great year. The 1990s were basically, it's an investor's dream.
From the start of the business day to the closing bell and beyond, CNBC brings you up.
The U.S. was in the middle of its longest economic expansion since World War II. Unemployment was falling, inflation was low, and everyone felt optimistic about the future. It was this rare Goldilocks economy, not too hot, not too cold, booming.
Just right.
Yeah.
And on Wall Street, the Dow Jones Industrial Average climbed over 11 points to 2721.62 on 130.
So the economy was booming, but why? What was driving it?
Technology. The 1990s were the decade when computers and the internet went mainstream. Personal computers became affordable. not those big ones that took up an entire room. The World Wide Web connected people and businesses, and productivity started climbing. Sounds so familiar. And suddenly, information was faster. It was cheaper to access. And that completely changed how companies operated.
Yeah, it must have felt like a revolution at the time.
Yeah, exactly. People started calling it the new economy. Investors believed the internet would rewrite the rules. The old school measures like profits didn't matter anymore because online businesses could scale infinitely, like super fast. And venture capital, keyword here, started pouring into anything with a .com at the end of its name.
Sounds very familiar. And I'm guessing the Fed, the Federal Reserve, must have played a role here too.
They did, actually. So after the collapse of a very big hedge fund in 1998 called Long-Term Capital Management, the Fed cut interest rates to stabilize the market. When we cut interest rates, that makes borrowing cheap. And that flooded the system with liquidity. So now we have access to cash. Access to cash allows us access to innovate. And you combine that with a 1997 cut in capital gains taxes, so reduced taxes, so fiscal policy and monetary policy here. And suddenly investors had every incentive to take big speculative bets.
Yeah, like history is totally repeating right now. It's crazy.
It is, right?
Wow. Okay. So money was cheap, risk was encouraged, and the internet felt like the future at that time. Sounds like the perfect recipe for overconfidence.
That's right, which is where irrational exuberance really comes in.
Ah, now it's making sense.
Yeah, and you could say it was a speculative cocktail, if you will. Booming economy combined with low interest rates and a shiny new technology that everyone wanted a piece of.
You remember when we'd go to cocktail parties in 1999 and 2000 and everybody and his brother, mother, sister would be asking you how to get in on this.
Well, when did it all really start taking off?
So the mid-1990s. The big turning point was Netscape's IPO in 1995. And even currently, we're like, is there a Netscape moment? Which we haven't had yet, but hold on to that nugget. That was for a company that wasn't even profitable. That sent a signal to Wall Street. Internet stocks could soar on hype alone. Because it's all vibes, right? And then after that, venture capitalists, they were throwing money at startups, hoping to find the next Amazon or Yahoo. Like, everybody wants this money, and that's where the credit crunch came in.
Wait, so Amazon and Yahoo both launched around that time?
Yeah, they did. Both in 1994. They showed that online businesses could grow faster and reach millions of people. Between 1996 and 2000, there were actually hundreds of IPOs each year, most of them internet related. 1999 was peak frenzy, actually. There were 500 IPOs in 1999, and over 90% of them were internet or tech startups. And that's a piece of the bubble that we need to know is like there's a lot of companies that are suddenly becoming public.
So you're saying they were both formed in 1994, but then they IPO'd between 96 and 2000?
Yes.
Okay. Which is pretty quick. I don't know how fast companies can typically IPO, but that seems quick.
Yeah. So they launched in 1994, but there were a ton of IPOs. Between 1996 and 2000, it was when the IPO frenzy like really started.
Yeah, that's wild. So like everyone wanted in, even if the company didn't have profits?
Exactly. Because it was new. We didn't understand it. Like an air fryer. I still don't get it. I don't know how the chicken is crispy. Like I don't understand how the chicken is crispy. It just doesn't make sense to me. But we didn't understand how to evaluate these companies because it's like, oh, internet, this is the next big thing. So eyeballs is what they were looking at, as in website visitors. But that didn't translate into earnings. That became more important than earnings. And so with all this capital chasing these ideas, valuations, they skyrocketed. That's why today we say, oh, PE's inflated, valuations. People are watching that constantly.
It's interesting because it was kind of before there was a big advertising platform and format for these companies, like how now we have Google ads. That wasn't a thing yet. And same with AI. And we're just now starting to see ChatGPT is going to be integrating ads because as we all know, ads are how a lot of platforms make their money. So it's very similar to what we're seeing now.
It is. And I think you're thinking the right way. So now we have to learn and say, okay, if we are comparing this to the dot-com bubble, instead of saying, what's the bubble? What are actually the companies that survived out of that? And it's how do we translate things into revenue and real earnings? That's what I think is different. And you've got a good point, for sure.
Interesting. Were there any policy changes that made this even easier?
Yes. So there was something called the Telecommunications Act of 1996. It deregulated, there's that word, the telecom industry, and unleashed about $500 billion of investment in fiber optic networks. Combine that with government incentives for local tech corridors, and the stage was fully set for a speculative boom.
Let's go ahead and wrap up this part. So basically, the 1990s were all about excitement and optimism. The economy was booming, money was cheap, and everyone thought the internet was going to make them rich.
Exactly. It was the perfect environment for a bubble to form. Everyone thought the internet would change everything, and it did. It really did, but not quite in the way that investors expected, to your point with ads. So it's a beautiful point. I like it.
Investors got so excited that they stopped worrying about whether companies were actually making money. And when you hear Jess say valuations were stretched, that just means stock prices were growing faster than the company's actual profits. Sound familiar? People were paying huge prices for businesses that hadn't even made $1 yet, all based on what they might become someday.
Exactly. And that's where things started to get dangerous, when excitement replaces earnings. Bubbles form. That's irrational exuberance. We're excited for no reason. So now we need to dig into how that speculation started taking over and the signs that the market was getting ahead of itself.
Okay, so we know the setup now. Like we said, booming economy, cheap money, internet hype. But walk me through what actually happened. How did this go from excitement to full-blown mania and then a crash?
So let's start in the early 1990s. Great year. It's when the internet officially opens up for business. The World Wide Web becomes commercial, and suddenly people can create websites, not just scientists trading data. Mosaic, one of the first popular web browsers, launches. And in 1994, companies like Amazon and Yahoo are founded, and investors start realizing the internet thing could change absolutely everything. It's like the ChatGPT craze.
Every business, no matter how large, and no matter how small, will be on the internet in the year 2000. It's the primary way that people will look up information. It will replace the yellow pages as we know it today.
So this is like the birth of the internet we all know now. People finally seeing its potential beyond just a research tool.
Exactly. Then comes the big bang moment, Netscape's IPO in 1995. The stock nearly triples on its first day. Even though Netscape isn't profitable, the single event sends a message: you can make a fortune investing in the internet. From that point on, Wall Street is hooked.
That's wild. So a company without profits triples on day one of its IPO. That's like lighting a match in a room full of fireworks.
And OpenAI is not a public company, but they're talking about being one this year. And it's going to be interesting to see what they do. And since they're public, we don't have an insight into their financials so much, but we do know that they're spending a lot of money, and it might be a non-profitable company that so many people are going to get into. So that's just something to watch. We haven't had a Netscape moment yet.
Well, OpenAI, of course, owns ChatGPT.
Yes,
so,
exactly. Yes.
So it is something to watch, but that is not advice.
Exactly. But you had a great analogy. Those fireworks keep going. So by 1996 to 1997, internet usage completely explodes. Everyone wants in. Venture capital, startups, retail investors. Like retail really came in. The NASDAQ, which is full of, at this time anyways, not so much now, but full of tech stocks, right? That crossed 1,000 for the first time. And even Fed Chair Alan Greenspan at the time steps in and warns about irrational exuberance, which basically means, hey, everyone, you're getting a little too excited.
Spoiler alert, no one listened.
No, they didn't. But companies like Amazon and eBay, they went public, and that started adding fuel to the fire. Then in 1998, we get this quick little reality check. There's an international financial scare, the Asian and Russian crisis, plus a huge hedge fund that we talked about earlier called the Long-Term Capital Management. It almost collapses, and the Fed cut rates to calm markets. That's what they do in the time of economic crises, which ironically just pours more fuel into the bubble because let's borrow, we need cash, let's do more.
Why would they cut? See, that's what I don't understand. Why would they cut rates in that circumstance instead of raising rates?
Well, because the stock market is not the economy. If the stock market is booming, you can still have a poor economy. And there was a crisis with long-term capital management and the Asian Russian crisis, which spurred the need to have some economic stimulation, which is where the Fed comes in. And then that same year, a tiny social site called theglobe.com goes public, and its stock skyrockets 606% in one day. Insane. That's the biggest first day pop in history. People start feeling like they have to invest or they will miss out. Like, freaking out.
Yeah, FOMO was real back then before they even knew what FOMO was.
Yeah, for sure. And then by 1999, pure mania. There are nearly 500 IPOs that year, most of them internet related. About 40% of all venture capital is going straight into .com startups. The NASDAQ jumps 86% in a single year. It hits 4,000 by December. And then we get the big symbolic moment, the AOL Time Warner merger. Announced in early 2000 for $183 billion. It's the biggest deal ever at the time, and it screams, the future is here.
It's like when two giant brands merge and everyone says, okay, this is it. Tech has officially won.
Yeah, exactly. But that was also the top of the mountain, because by January 2000, .coms, they're literally everywhere, even in the Super Bowl. 17 internet companies buy 30-second ad spots for $2 million each. It's peak overconfidence. And I think we're getting AI in the Super Bowl this year. Like, the parallels are crazy.
Oh, wow. Yeah, 17. That's insane.
So on March 10th, though, 2000, the NASDAQ hit its all-time high. 5,048 is the number. But right around that time, insiders, people who work at companies like Dell and Cisco, start selling their shares. So this is an important component. If you have stocks that IPO and you're an insider, we went over this in episode 2 or 3, but when you are initial public offering, it's the first time you're offering your shares to the public, you are a more advanced company. And that's normally when VC starts cashing out at that time. But there's a lockout period. So if you're an insider, you can't sell your shares for a certain amount of time. When that lockout period lifted for a bunch of IPOs at the same time, insiders started selling at the same time. That's a bad sign. So that happened. And then a few days later, Japan announces it's sliding into a recession and global markets wobble. And then the NASDAQ starts to drop.
Okay.
Yeah.
So that's where the cracks start to show.
Yeah. And then it happens super fast. So
Oh, wow.
March 20th, 2000, Barron's runs a cover story called Burning Up, warning the internet companies are running out of cash. Does that sound familiar?
Yeah.
We need to make sure they're using free cash flow. Like right now, we're like, free cash flow. They're using free cash flow. It's okay. The next day, a software company called MicroStrategy. Can we just LOL there? Yeah, because MicroStrategy is a company. They changed their name to Strategy Now that holds Bitcoin, which I think is really funny. They announced accounting problems and lost 62% of its value in one day. And to make it worse, the Fed raises interest rates. And it was one of 6 hikes around that time. So now we're moving into a restrictive Fed policy. That pulls away the cheap money that had been keeping the party going. So here's the difference there. We are in a Fed easing environment when we're in a Fed easing environment now, but when AI was really taking off, we were in a Fed raising environment. Thank you, Darla. One of 6 hikes, but this is a key differentiator that I think is important to know. When we had this big AI boom, the Fed was raising interest rates and we still had this boom. Now the Fed is lowering interest rates or we're at pause. That's a different parallel from the .com bubble. Now we're getting into easier money, which could help. We're probably in 1996.
Okay. So it needs to be very strategic what happens with the new Fed that comes in and replaces Papa Jerome Powell. Powell.
That's why if we're drawing parallels and we want to talk about the .com bubble, you have to think about the environment as well, not just the series of events.
Okay. There's a lot of similarities, though, so far.
So many similarities, but there's also people are cautious and learned. And like, we're looking for free cash flow. There hasn't been a bunch of IPOs, but it looks like IPOs are about to heat up.
So we've learned a few things. And at this point, March 2000, it's like, it's not popping, but the air is starting to leak out of the balloon a little bit.
Yeah, exactly. And so by April 2000, things started unraveling. A court rules that Microsoft has violated antitrust laws. Its stock drops 15% in a single day. The NASDAQ tanks 8%. A few days later, April 14th, known as Black Friday for tech, the NASDAQ falls 9% in one day. Within a month, it's down 34% from the peak.
That's brutal. And this is when the bubble officially bursts?
Yes. By mid-2000, dozens of .coms are just folding. Pets.com, which had become a symbol of the boom with its sock puppet mascot, it shuts down just 9 months after going public. By the end of that year, internet stocks have lost about 75% of their value, wiping out roughly 1.7 trillion in market cap.
That's a lot. That's hard to even wrap your head around.
Oh, yeah. And it gets worse. We're not done.
Wow.
By 2001, the U.S. slips into a mild recession because this is people's money that they invested. Retail got involved. That's why it's so important to, as a retail investor, to understand things. And only 3 .coms advertised in the Super Bowl that year, down from 17. So we could watch Super Bowl ads to understand. That'd be a fun little study, actually.
Yeah, part of history. Yeah.
But then the September 11 attacks hit, and corporate scandals like Enron and WorldCom pile on, shaking investor confidence even further. So now we're into the great housing crisis. The Fed cuts rates aggressively, trying to soften the blow, but the damage, it's done. It's done.
So when did it finally hit bottom?
So the bottom, backing up a little bit, was October 2002. NASDAQ bottoms out at 1,114, down 78% from its peak. Huge loss from peak to trough. In total, around 5 trillion in stock market wealth just evaporates. And more than half of all .com companies disappear entirely. It was one of the largest wealth destructions in U.S. history.
Yeah, I do remember some of that. And that's when I think when the boomers started kind of losing faith in the stock market or just, freaking out. Because I remember my parents freaking out about all of their retirement and everything. The market went from a total gold rush to a ghost town in just 2 years. That
Bubble inflated fast and it deflated even faster. And that poor generation, a couple years later, got hit with the great financial crisis. So, yeah.
Hard times. I hope we're all taking away some lessons from this as investors going forward. So let's just sum that up. Here's the TLDR, or didn't listen. Hopefully you're all listening. The internet opened up in the early 90s. Money was cheap. Everyone wanted in. Netscape's wild IPO kicked off the craze. Venture capital flooded startups. And by 1999, the NASDAQ was soaring as people chased internet dreams instead of profits. Then the cracks appeared. Interest rates rose, companies ran out of cash, and one by one, those can't-miss.coms started collapsing. But by 2002, trillions with a T, in market value had vanished, and half the companies were gone.
Yeah, exactly. It's one of the fastest booms and busts in history, and a masterclass in what happens when excitement outpaces reality. Earnings are reality. So up next, we need to unpack why investors ignored the warning signs and what drove all that speculation. Because the market really does move on vibes. It's an auction system.
Oh yeah, it gets hyped up
all the time.
And I am guilty. Sometimes I get into the hype too when things happen and have to put myself in check. Thankfully, this podcast has taught me a lot to what to look out for. So
yes,
I don't get swept away like I used to when we first were able to get Robinhood and start the GameStop craze. I think we can all learn a lot of lessons from history so far.
GameStop was irrational exuberance, though. What a great example, because everyone was excited, but
there was a lot of
reality
hype
check
and no real profits or earnings to back up the hype. Yeah. Just we all rallied. A lot of people lost money. So yeah,
that's true.
Lessons learned. So we've covered the timeline And now I've got to ask you, my dear co-host, why did so many people ignore all the warning signs? And why didn't anyone realize how overhyped everything was? Was it just all that energy and like the dopamine was flowing and everyone just wanted in?
Oh, for sure. Herd mentality, right? It's the fascinating part. It all comes down to investor psychology. And honestly, this is why I like technical analysis, because fear and greed and humans will be humans. And so much you can do with that. Anyways, it's how emotions and crowd behavior just drive markets. The late 90s were a textbook case of what economists call speculative mania and irrational exuberance, the words of the day.
Okay, wait. So what does irrational exuberance actually mean?
So it basically means investors were losing touch with reality. People got so excited about the internet that they convinced themselves the old rules don't apply anymore. They were like, no, this is the next big thing. I don't care. Like, they'll make money. They'll figure it out. They figured out how I can like go talk to you on this thing. That's gonna make money because it's amazing. Profits, cash flow, those became old economy ideas. Back then, just adding .com to your company name, like you're literally in a garage, you add .com to your company name, it made your stock skyrocket. And investors didn't care if you made money. They cared if you might make money someday.
Yeah, it's just vibes over value.
Exactly. And when you put fundamentals or you layer that on, which completely went out the window, but traditional metrics like the PE ratio, which compares a company's stock price to its earning, they were ignored. The NASDAQ's overall PE shot to 90. That's crazy. Compared to about 32 for the S&P 500, that's more than double what's considered healthy, which is crazy.
Yeah, let's stop there because that's the importance of this podcast. That's why we teach y'all about PE ratio and things like that. So that's a big one. If someone's new to investing, what does a PE of 90 mean?
Okay, so I actually thought of a really fun analogy for this the other day. We're going to bring it in. So you need earnings follow through. So price is your hype and earnings is forward earnings anyways, are expectations. So you're looking at, does the price relative to the expectations actually make sense? Do you need follow through? So if you're thinking about like investing your time in a man, is there the price is like overhyped, like you're overvaluing it, like you're getting so excited with like you and your friends or whatever, and earnings is your reality check. If he isn't buying you flowers or doing whatever, that's overhyped. I guess is the way of saying that.
Yeah. Are you like just too excited with NRE, new relationship energy, where you're not really evaluating all the traits and qualities you should be having to make a lasting relationship work?
Exactly. That's true. And then if there is no earnings follow through, you basically were betting on something because you're like, no, I think it's better than what I see. And you don't see it. Like that is an over extended PE ratio.
Yes. The vibes are hyping you up, but
it's not really happening. You're in your head.
Is there substance there? Like, Is there anything actually there?
Exactly. That's PE right there. So,
okay.
Put some math.
That's great. I love it.
Thank you. Thank you. I thought you would. A PE of 90 means investors were paying $90 for every $1 of company earnings.
Which is a lot.
Yeah, it's a ton. So it's like buying a lemonade stand that makes $1 a year. Like, and it's not even the bare minimum. So, but you're paying $90 for it because you hope it will sell.
If the stock's not even of the bare minimum,
exactly,
because all that's there, let's evaluate what more it should be doing. Don't just get hyped up over the bare minimum, everybody.
Exactly. It shows people weren't investing based on reality. They were investing based on their imagination. Don't make it up. Look for follow through. Is he just saying that he'll buy you flowers or did he actually do it? Right?
Don't ignore those red flags.
That's correct. That's the PE ratio.
Oh, we still need to do our red flag and green flag episode of the stock market.
That would be great. I want actual flags for that though. We got to get those.
Yes.
All right.
We'll tie it all in.
Yes.
Well, that makes a lot of sense. I hope we all understand PE ratio better now. I really feel like that puts it into perspective.
Yay.
And let's see, what else? The media probably didn't help, right?
No, not at all. Yeah, they love headlines. CNBC and financial news outlets, they were covering the market like a sporting event. Those literally started booming at this time, actually, which is why its shows are literally sporting events.
I bet that's where we started getting all these, like, we talk about the finance bros talk about investing in sports terms. And that's why if you don't follow sports or you're not into sports, you're just like, what are they talking about? What does this mean? And there's so many sports analogies. I wonder if this is like
so many
where it started.
I mean, it started because it's predominantly men that were there, and that's
Right.
just what they know.
Yeah.
But they play-by-play commentary. They were cheering when stocks were up. Analysts
Right.
became celebrities, hyping tech stocks to bigger and bigger audiences. The constant coverage created a kind of psychological contagion. When everyone around you is making money, it's just super hard to sit out, FOMO.
Yeah. Fear of missing out. That happens. Don't get
Exactly.
swept up in it.
People saw their friends, their neighbors, cab drivers getting rich and thought, if I don't buy it now, I'm going to miss my shot. Not going to miss my shot. Was that a Hamilton reference I tried to make? Not Taylor Swift. Look at that.
Look at
right?
you.
Wow. Diversification. But some quit their jobs to trade stocks full time, and they were convinced that they cracked the code.
Yeah. It wasn't just Wall Street. It was everyone.
Oh, yeah. VCs, day traders, even regular employees. Startups were handing out stock options like candy, which is very common for the tech world, though. And for a while, people looked like paper millionaires, at least on paper. But only a few actually cashed out before the crash, like Mark Cuban, who sold broadcast.com to Yahoo for $5.7 billion. In stock, and then he smartly hedged it. Meanwhile, legendary investor John Templeton, he was shorting .coms, called it a period of temporary insanity.
Temporary insanity. That sounds about right. And these companies were spending the money like it would never run out, right?
Oh, completely. Their motto was get big fast. Many of them burned through cash on marketing. Sometimes 90% of their budgets went towards ads, parties, flashy PR campaigns. They were focused on mind share rather than market share, Super Bowl ads, rooftop launch parties, even companies giving away products for free, all to look successful and attract more investors. Like the way you look, marketing is so important. It's crazy.
Yeah, they were just performing success instead of actually earning it.
Oh, that's such a great way to put it. Exactly. It was all image and momentum. Everyone convinced themselves this time is different, which I mean, I argue this time is different like always, but history echoes, rhymes, haunts, whatever. But, there are similarities and this time is different, but the crash is still coming. That's the consistency, right? And so when a market is driven by excitement instead of earnings, it's only a matter of time before gravity takes over.
So if we boil it all down, the dot-com bubble wasn't just about technology, it was about people. Investors got caught up in the story, not the substance. And everyone thought profits didn't matter, valuations didn't matter, and that this time would be different. The FOMO kicked in, the media amplified the hype, and even smart people started just believing in this fantasy of being rich.
Oh, yeah. Well, because markets move on emotion just as much as economics. And during the dot-com era, emotion completely took the wheel. We have to make this a part two because there's so more. We need to look. We do.
Yeah.
We need to look at how that psychology showed up in company behavior and why so many businesses built on dreams, not data, and how that came crashing down with some case studies, the role of fiscal policy and how the dot-com era shaped markets. There's just I feel like we always do all these series, but this will just be 2 parts.
Yeah, I mean, there's a lot that we need to learn and take away from what happened.
It's important.
Because we don't want a lot of people to lose all of their investments again, we want people to be smart and strategic with what they're investing in, as we always say.
For sure.
Let's do a recap of however many parts this ends up being, but we'll do a recap of the part one of the dot-com bubble. So we started with the economic backdrop. The 1990s were this perfect mix of low inflation, easy money, and exploding technology. Everyone felt optimistic, and the internet felt like the next industrial revolution. Then we walked through the timeline from Netscape's 1995 IPO lighting the spark to the NASDAQ soaring past 5,000 and then crashing almost 80% by 2002 when reality finally caught up. As we just covered why it happened, investor psychology plays a part. People got swept up in the hype, ignored profits, and believed this time is different. It wasn't just a tech bubble, it was a human one.
And now that we've seen how emotion drove the market, it's time to look at the companies themselves, the business models, the spending, keyword there, and why so many of them burned out once the easy money dried up.
All right, well, that was a lot. Very valuable information, history lesson. That'll be a wrap on our part 1 of our deep dive into the dot-com bubble.
Yes, this is a history podcast too. I also thought once we finish the Fed series, we should go through the history of all the crashes too. That would be kind of fun.
Yeah, we like on our 100th episode, we kind of skimmed over it, but deep diving in. I think that's how we really learn from mistakes of the past so that we don't make the same mistakes now as investors.
Yeah. It's my favorite part of this podcast is like doing the deep dives. I love it.
I usually hate history, but like history, obviously is very important and we can really learn a lot from it. So I'm glad we're doing it.
Me too. But if you did love this episode and our history class today, do us a favor, leave a rating, tell us how you really feel, and write a review. Thank you for all the ones that we have received, by the way, for not doing this episode for a long period of time. You guys are so nice.
Yeah. And we appreciate it. We know we took a hiatus and we appreciate everyone still tuning in and listening and catching up on our 100 episodes and still reviewing us. We really appreciate y'all. So don't forget to share this with someone who's, let's just say, irrationally exuberant about the next big investing trend that might be happening right now. We all know at least one of those kind of people. So make sure you're sharing this information with them so they don't make the mistakes of the past.
We sure do.
And make sure you're following Market Maker so you don't miss part 2. Make sure you have notifications turned on, all those good things, because we're going to look at what happened after the crash and the surprising success stories that came out of it.
Yes. And remember, when you build knowledge,
you break barriers.
Remember, investing involves risk. There is always potential to lose money when investing in securities. Market Maker provides educational content and resources for informational purposes only. We are not registered financial advisors and do not provide personalized investment advice. Any information provided by Market Maker on our website or podcast is not intended to be a substitute for professional financial advice. Market Maker is not liable for any investment decisions made based on our content.